Hi, this is Jackie Ann Patterson here to talk with you about the process that I use to monitor the market each weekend for changes and to understand the broad market direction. I refer to it as the 9 essentials of market analysis, and it's a way of blending technical and fundamental analysis to gain perspective on the markets. First, let's start with disclaimers. Trading does involve loss, and it may not be suitable for everyone. I do trade myself, and this presentation is for educational purposes only. I'm not trying to buy or sell securities. I do a lot of backtesting, and I'll refer to that throughout the presentation, and it's important to realize that backtesting is not reality. It does give us a glimpse into the historical performance, and I find it a very useful tool, but it is definitely not reality. Okay, with that, let's get started. I'm Jackie Ann Patterson. As I mentioned, I'm the editor of BackTesting Report. I'm a computer engineer by training, and I got interested in trading and started out pretty well and then began to lose money. So I started to backtest my strategies, and things got a whole lot better from there. So what I'd like to talk to you about today is the process I use each week to monitor the market and look for opportunities. Now, this presentation is it's very similar to what I gave at the Money Show in Las Vegas. And if you attended that session, you'll notice that I've rearranged the slides quite a bit. Still got the same activities, the same 9 points, but I think this makes it clearer and more concise. And also accompanying this video is a market analysis where I actually apply this and go through the steps with the websites and with TradeStation in the manner that's mentioned in these slides. When I give this at a live show, of course I'll intersperse this with live market analysis. So if you're watching this as a preview to the next show, which is in Dallas, coming up in June of 2012, you can look forward to seeing slides very much like these and the live market analysis, which will reflect what the market is doing at that time. And if you're watching after that show, I will record another market analysis to pair with this video so you can see how I apply this that I'm talking about. And in person, we do a prize drawing, and I've got a survey that becomes the entry form and also allows you to join the mailing list and receive this link to the slides. Okay, let's get started here. So the number one thing, and these are not in any particular order, by the way, it's in the order mostly that I go through them, and part of that is driven by what's on websites and what's available in a tool. But I think the first thing is to get a fundamental idea of what's happening with the economy. And I do that by looking at the conferenceboard.org and looking at their leading economic indicators. And I learned to do this by reading the weekly commentary of John Hussman, who manages a fund, and John Malden, who's an economist who works with a lot of hedge fund managers. And by reading their comments each week, I learned that the leading economic indicators really have some basis in fact, that they lead the economy and perhaps lead the market. So I'm by no means an economist, so I just refer to this website to see what all the people who are economists think about the economy. Okay, so here's the point where I would shift and show you that website, and you can look at the sister presentation to this to see what's happening with the economy at the time I'm recording this. Okay, number 2, after looking at the state of the economy, to assess the situation of the stock market, we got to look at how it's valued. And of course, what we want to do is buy low and sell high, or sell low and sell high and buy low. In any event, you always want to be on the right side of the market values. And where I look to find this is a chart that's produced by Robert Schiller, and it's got the S&P 500 inflation-adjusted price-earnings ratio, and this goes back for over a century, and it gives us good insight into where the market is now relative to where it has been in the past. And I learned to do this by reading the backtesting. I call it backtesting. They essentially looked at the returns of the S&P 500 from various valuations going back for 100 years. And I've seen this data both analyzed both by John Hussman and by John Malden. And it makes a lot of sense to me. So I try and keep an idea in mind of where we are in the market valuation. So that's step 2. Step number 3 is to look at the seasonality and see where we are in terms of the calendar. So I say look at the calendar, but we always kind of know what month it is, where we are in the election cycle. So as I'm recording this, we're in May of a pre-election year. So the pre-election is usually the time when the market's strong, but May, we've got the adage, sell in May and go away. So we've got some different forces battling it out on the calendar front. And there's also different things that happen, I believe, and I couldn't quite track down my reference for this, but on the first and third weeks of the month tend to be stronger. Second week is not as strong. And where I saw the best backtesting, I think, of the calendar and the election cycle in a book by Ken Fisher called The Only 3 Questions That Count. So I do my own backtesting on a lot of things, but if somebody's already done it to my satisfaction, I'll take their work and try and build on it. Okay, so let's look at number 4, the market trend. As you know the adage, the trend is your friend. So I try and assess this by looking at the major indices, like say the SPY or the QQQ. And I just take a TradeStation chart and look to see if the price is above the 200-day moving average. And this is something that came up as an important dividing line in the moving average backtesting reports that I did and that are available on BackTestingReport.com. And another way of assessing the trend is to see not only where the prices are, but where are the moving averages, and specifically, where is the 50-day moving average compared to the 200-day moving average. And this is covered, at least the crossover between these two was covered in Golden Crosses and Stop Losses backtesting report. And here again, I show you TradeStation and the current charts, but that's already in another video. And that other video, I go through it in the manner that I do for the Platinum subscribers to my Divergence alert service, because I don't always go through the entire process of describing what each line is for and how they relate to each other. Okay, the 5th thing to look at is the overbought and oversold. Gives us a way to measure the ebb and flow of the market, because even when it's moving along on a major trend, it's still going to have variations up and down. And so I look at the channel position on the daily chart of the major indices, and I can show you that on a TradeStation chart. I usually use a Keltner channel, which takes a 20-day moving average of price and then adds 3 ATRs above and subtracts 3 ATRs below to make a channel. And then pay attention to where the price, whether it's up at the top of the channel, oftentimes we'll see it hit the top of the channel, bounce back down, or hit the bottom of the channel, go back up. And I did cover some trading channels in a backtesting report. It's part of the exit strategies report because I often use them as profit targets. Another thing that turned out to be useful in terms of overbought and oversold, I did some testing for Fidelity. They hired me to do backtesting research and write some articles. And in one of them, I tested a lot of oscillators. And you may notice that what's not listed here is an oscillator. And that's because they didn't test out that well. At least they didn't perform any better than looking at the 10-day new high or new low. So if the price has, for example, if the price has fallen and it's at a low, it's at a 10-day low, which would be a 2-week low, then that is often a time historically that's about as far down as it's going to go in one go. It might start up a little bit more often than not. And likewise, if the price has hit a new 10-day high, that it's higher than it's been in the whole past 2 weeks, that might be enough upward movement for a while, and it might take a break and make a pullback. So this is the sort of thing that's happened over the past 5 to 10 years in the stock market. The 10-day new high and new low has worked out to be as important as the function of any oscillator, such as stochastics or the MACD histogram or the RSI or any of a number of other technical indicators that have been proposed for use. So just keeping it very simple with looking at where the price is in terms of its previous highs can give you a whole lot of useful information. Okay, number 6, looking at extremes of fear and greed. So emotion drives human behavior, and this is what drives the market. And it's hard to get at this directly. I mean, you gotta kind of watch. You gotta have your security camera eye on what people are doing. You can also see some of this in the options activity via the VIX, which shows a measure of how much fear or complacency is in the market, and also via the put-call ratio, which shows a similar thing. So again, I could show you charts of the VIX, and I'm hardly an expert in the VIX. What I do is I look for support and resistance, and this is kind of based on going back through time and looking at how the VIX has worked in concert with the S&P 500 over the past couple decades. I also look at the put-call ratio, and I look for a return from extremes. And what I mean by that, and you see on the chart, when a lot of puts have been purchased and that ratio goes extremely high, then it'll turn around and come back. After a certain point, everybody who's been bearish is, everybody who's going to get bearish has been bearish. So when it turns and comes back, then we tend to move and have a bullish move, and that becomes a buying opportunity. So this is a contrarian indicator, and you'll see it when you watch my video, the market analysis, or see this in person. You'll see what I mean. And I got this from Alexander Elder in his book, Trading for a Living, and then look back through the behavior of the put-call ratio over the years to see the times that, in fact, the extreme movements did mark a bottom or a top in the market. Okay, breadth is very important. And one of the things that I've seen in a couple different places, both from Tom McClellan, who's the son of the inventor or the inventors of the McClellan oscillator and McClellan summation index, and also from Gerald Appel, who is the developer of the MACD and wrote a book, Technical Analysis of Power Tools for Active Investors. Well, one of the things about breadth is that the market often starts to narrow before it really declines. So we'll often have the price run up, and the full market participates in the first run up. Then it pulls back, and then as the market goes up again, it's only a few leaders that are carrying the market, and it starts to look like this picture over here on the side. And when we have situations like this is very dangerous, where there's just one guy climbing up the ladder and everybody else is exhausted. So if this is, right about now, this would be Apple, who's been climbing up and becomes about the only company that's still going up. Everybody else is exhausted. Then the market becomes very vulnerable for declines. And we can see this by looking at the McClellan summation index indicator and looking for divergence between price and the summation index. And I learned about this from Tom McClellan at a presentation at the LA Traders Expo. And there's a whole lot of information on his website about that. So I put the whole link right here. You can pause the video if you need to write all that down, or else it'll be in the slides. Okay, so I put a little red mark here to show that's what we don't want, is just one guy climbing on the ladder. We want to see full participation by everyone. Okay, number 8 is keeping an eye out for a flight to safety. What happens is the yield spreads tend to widen during a crash, and John Hussman, in his weekly commentary, keeps a keen eye on this and has the tools to look directly at what the yields are and what they're doing. And what I fashioned is my own way of finding it with the using the data I had rather than going to purchase a lot of data feeds on bonds just for this reason. I instead took some ETFs. One is the LQD ETF, which is composed of corporate bonds and about 7 years duration. The other one is IEF, and this is treasury bonds of 7 years duration. And what I do on a TradeStation chart is I monitor the difference between the two. And what I'm looking for is abrupt changes, because what happens is when the people, and I mean big people, that trade large quantities of bonds, well, they're happy and content to take risks. They will move more and more money into corporate bonds, more and more into things like LQD or things that are reflected in LQD. But when they start to worry, and in particular when they jump on this plane and hold on tight to take a flight to safety, they're going to be dumping out of the corporate bonds and moving into the treasury bonds. Now, not necessarily into the same duration, but it helps to look between the two. And you can definitely see times, such as in 2008, where LQD just dumped just before the market fell down a waterfall. So this is definitely a canary in the coal mine type of signal to keep an eye on, and can spell the difference between just a regular pullback and a big crash coming. Okay, one more. The ninth area that I look for, near and dear to my heart, is divergences. So Alex Elder calls it the strongest signal in technical analysis, and that prompted me to do a lot of backtesting and a lot of work with MACD divergence. And I've written a divergence detector add-in to TradeStation that allows you or me or anyone to scan the market and marks the times where there's divergences between the MACD and price. And what I'm looking for, of course, is divergences on the main indices, and that can provide some insight into the health of the market. And I also scan the market for divergences on individual stocks and ETFs. And well, one of my customers who knew that I was doing these scans across the whole market said, hey, well, what if you count up the number of positive divergences and the number of negative divergences? And that might give us some insight, kind of like this X-ray, some insight into the health of the overall market. So I did that, and I did a historical perspective and backtested it, named it the divergence count indicator, and did a backtesting report. So that's available to subscribers of divergencealerts.com, which is the service where I scan for the divergences. In any event, since this is kind of a big, fairly new thing, it's been around now a couple years that I've been using it, I'll show you a little bit. I'll show you the live, of course, what it reads right now, but just from a historical perspective, here you can see the divergence count indicator in action. So here's a plot of the Qs going through time, and this is from 2010, so this plot has been around for a while, but it's such a good example, I want to use it. And then down below that, in TradeStation, I have fed back in the data, the count of the divergences that have been found by my scan. I have TradeStation read this in as external data and plot it in the middle pane. And then down at the bottom pane, TradeStation is reading in my count of the negative divergences and plotting them. Well, when you look here, it just jumps right out at you. And I did backtest this to 1994 to see that it does hold true in many circumstances, that when there are times that there are a lot of positive divergences and very few negative divergences, these tend to be, or at least have historically tended to be, good times to buy. So when I did this backtest, I did use a stop loss, and I think that was critical to its success. But of course, we'll all trade with a stop loss, and I think that the divergence count indicator does help point out the best times to apply the MACD divergence and when to be buying into the market, and has proved to be, historically at least, a useful tool. And so what the specific rules are, I call them buying zones. So when we have, they're kind of windows of opportunity, and when we have a lot of positive divergences, that's when the P zone is open, I would say. And this means that taking a moving average of the positive divergence count and seeing that stay above 10, that means there's a lot of positive divergences, relatively speaking, in the market. Now conversely, the end zone is a situation where there's very few negative divergences. And by few, I mean if you take the moving average of negative divergences and that stays under 5, that's very few negative divergences, because we tend to have a lot of them in the market at any one time. So those two things I tested. The all zones is the union of the P zone and the end zone, which means you either have a lot of positive divergences or you have a lot of negative divergences. And this is probably a detail you don't need to concern yourselves with, but this is the different states that I define. And so I keep track of the divergence count, and I always keep my eye out for the P zone and the end zone, and point those out in my market status videos. Okay, so as I say, we would have gone through, if I had the tools and this were a real live session, I would show you on the screen exactly what the market is doing right now with respect to these 9 different areas. And I encourage you to watch the other video and see what's happening, at least on the day that I'm recording this. Okay, to kind of summarize, if we put it all together for a decent chance to avoid loss, the best case time to buy would look something like this. It would have an uptrend, a basic uptrend, and we'd see that in terms of upside breakouts from the trading channels, and we'd see positive divergences, but we might see a pullback. We might see it as a little bit oversold. So we might be at a 2-week low within a long-standing uptrend, the price up over the 200-day moving average, but down at a 2-week low. And as far as the calendar is concerned, looking in the fall of the year and a pre-election year, this can be the best time to buy. Now, the sentiment, when we see a peak in fear, that is our buying signal there. Once everybody has agreed that it's a bull market, that's usually too late to buy. So the prime time to buy is at a peak of the fear, and as everybody is becoming less fearful. They've been as fearful as they can possibly get, becoming less fearful. The other thing I wish we had is a low valuation. Of course, to get there, the stock market is going to have to drop. So that's probably in the be careful what you wish for. So I don't think we're at this point right now. And also, I think it's in the background. Let's see. In order to have the right context for a nice long bull market, we need to be in a situation of economic growth and seeing the economic indicators pointing upwards. And finally, I would look for widening government corporate yield spread. So look for more and more investment in corporate bonds. That shows that there's a sense of safety in the market. And definitely you don't want to see the converse. I mean, when you do see the converse, that's the best case time to sell. You know, when you're seeing narrowing corporate and government yield spread, that says that big bondholders, who are usually pretty smart about these things, are getting worried and jumping out of the market. They're on their flight to safety, so it might be a good time to buckle your seatbelts, because we're going to have some rough weather. Other things that indicate time to sell when we go into an economic contraction. When the valuations are high. Now this in itself, you know, you never know how high is too high. Things can always go higher, but this is part of the context of this overall set of sell signals. So another area is looking at the sentiment, and when people are having an extreme of complacency and greed, when the put-call ratio is at a low, when the VIX is at a low, these are times to consider selling. It's time to be thinking about when to sell rather than when to buy. Calendar-wise, May through June has been about the weakest, or the early part of the weakness, and post-election years have been the worst. Okay, and then as far as the trend, this is the mirror opposite of the other, looking to see that the trend has turned down, which could well be breaking down through the 200-day moving average. And if there's been a nice long run, that can take a while just to get down to the 200-day moving average. And that will be accompanied by negative divergences up at the top and downside breakouts as it moves down. And if you can find a spot where the market's kind of overbought within that, that's probably a good thing, making it that best case time to sell. Okay, so that's how I would put it all together. And in summary, we've talked about 9 essentials of market analysis. So these are the things that I do. It's not like it's the 9 essentials. There's probably more things that would help to look at, but I caution you to be careful because sometimes adding more data makes us feel like we've gotten smarter, but doesn't necessarily mean that it's added new information. So that's why I've tried to pick areas that are different from each other and shed new light on the stock market and help figure out where it is now and where it might be going and where the opportunities are. Okay, so thank you very much for your time. And in a real situation, we would be doing a drawing for a video series or some software. And as it is, I'll just point you to a couple places for more information. You can look at the Money Show subsection of the Divergence Alerts website and check out the free page on my backtesting blog. Okay, thank you very much, and I wish you the best for your success.